Okay, this recording will cover bond issue. I'll do one at par, one at a premium, and one at a discount, and I'll show you what the interest payments look like for these three. So this is going to be based on example 15.2 in the textbook. The textbook has parts A, B, and C, and then I've added D and E, which are the issuance of a bond at a discount and a premium. So the bond is $500,000. It's got a 10% interest rate and it's a 10-year bond, and the interest is payable annually on January 1st. So in the first instance, the bond is going to be issued at face value, so that's at 100% of the face value. So on January 1st, 2017, the bond is being issued. So you're going to debit cash for the face value of the bond, which is $500,000, and you're crediting the bond payable. We're going to do an adjusting entry at December 31st for the value of the annual interest payment. So that would be $500,000 times the interest of 10%, giving us a payment of $50,000. Now, because this is at the fiscal year end, it's going to be interest payable. So at December 31st, you'll have interest expense of $50,000 in interest payable. Now, our interest payable date will be 1 year from the date of issue. So the interest payments will all happen on January 1st. So the annual interest payment date will be January 1, 2018. So on January 1, 2018 is when the cash will flow. So the interest payable gets a debit and the cash gets a credit for $50,000. Now, even when the bond is issued at a discount or a premium, the cash payment or the coupon will always be $50,000 because the bond is $500,000 at 10%. So the coupon will always be based on that $500,000 face value with a 10% rate of interest. So in D, when the bonds are issued at 97, so this is when they're issued at a discount, we're going to be multiplying the bond face amount times the 97%. That gives us a dollar amount of $485,000. So we receive cash of $485,000. The bond payable is recorded at $500,000, and the difference is the discount on bond payable. So when we record the interest amount at the end of the fiscal year, we have to amortize that bond discount over the life of the bond, and we're going to do that straight line. So we have to amortize the discount at $1,500 a year. So at December 31st, we're going to show the interest payable at $50,000, but we have to amortize the discount at $1,500. So the bond interest expense is going to be the combination of the $50,000 of interest payable and the $1,500 of the discount that's being amortized to give us interest expense of $51,500. This is why when a bond is issued at a discount, the cost of the bond is going to be higher than the cost when it's issued at par at face value. But when we make the payment, or the actual cash value or the cash we have to pay is still going to be $50,000 because the coupon is based on the face value of the bond and the interest rate that is stated on the bond, the 10%. So in this case, what's happening is the bond gets issued at a discount because the bond market is requiring a higher rate of interest than the stated rate of interest. So the bond pays 10%, but the market currently is demanding that the bonds of this level of risk pay a higher amount of interest than this bond is paying. So for letter E, the bond is being issued at 102, so it's giving you they're paying you more than the face value. So this bond is going to sell for $510,000. So that is going to be at a premium, and the bond issues at a premium when the bond is paying more than the market demands. So this bond is paying 10% interest and the market is demanding something less than 10% interest. So at the date of issue, we're going to receive $510,000 in cash. The bond payable is $500,000, so that's what we have to pay back in 10 years, and we have a premium, so we receive $10,000 more than we have to pay back. So the adjusting entry at the end of the fiscal period, we're going to amortize this $10,000 over 10 years. So $1,000 a year is going to go towards reducing the interest expense. So on December 31st, we have the interest payable, so that's the coupon amount, and we amortize this bond premium. So the interest expense only ends up being $49,000. So you can see, because we sold it at a premium, the cost of the financing or the cost of the bond is lower when it's sold at a premium than it is if it's sold at par. And again, the amount of the payment is the same regardless of whether it's sold at face, a discount, or a premium, because that is going to be based on the face value and the interest rate that are stated on the bond. This recording has an example of a retirement of bonds at maturity, an early retirement of bonds, and a conversion of bonds to stock. So this is based on exercise 15-5B. Stern Company has issued $4 million of bonds at par or face value, and those were issued on January 1st, 2017. So we're going to start with the journal entry to record the retirement of the bonds. Okay, so assume the bonds were issued at face. So when they were issued, we had a debit to cash and a credit to bonds payable. So if these bonds at maturity, when they are retired, you basically would flip that and we would be debiting bonds payable and crediting cash. So this is assuming that all of the interest payments are made. They didn't give you an interest rate here because it doesn't really matter. You just would be making the interest payments in full as they come due. So there would be an interest payment at the date of maturity. So if this were a 10% interest payment, you would have $400,000 of interest paid at the date of maturity. If it was paid annually, you'd have a $400,000 interest payment on 1/1/2018 and one every year until the bonds are due. So the date of maturity would be 1/1 of whatever year is appropriate. All right, so now we're going to record the retirement of the bonds early. So these would have to be callable bonds because you would have to be able to buy them back early. So in this case, we're calling the bonds and we're buying them at 98. So they were paying a discount for them. And when the bonds were originally issued, they were issued at a premium, and there's some of the premium that still has not been amortized. So when we go to do this transaction, we have to figure out what numbers to record. So the first thing we want to record is clearing off the bonds payable. So the bond payable we have to take off the books is the whole $4 million. And since it says the premium on the bonds is $18,000, we have to take off the premium as well. The amount we're going to be paying is the $4 million times the 98, because that's what we're paying to get the bonds back. So the cash outflow will be $3,920,000, and then we have to make this balance. So we've got $4,018,000 on the debit side, and we need to have $4,018,000 on the credit side. So in order for that to balance, we need $98,000 to get the credits to be $4,018,000. So that would give us a gain on retirement of $98,000. So this would be an early retirement of the bonds. So these would have been callable bonds, and we're buying them back off the open market before we hit the maturity date. And in this example, we are converting the bonds into stock. So the conversion is that we will take the $4 million of bonds and we're going to turn them into 120,000 shares of stock, and the stock has a par value of $10 per share. We're going to assume the bonds were issued at par. So we're going to have to debit $4 million of bonds, and we need to record 120,000 shares of stock. So the stock, you have to record it at a $10 par. So 120,000 shares at a $10 par is 1.2 million, and then we have to have the debits equal the credits. So your excess over par account has to be enough so that your credits equal $4 million. So this in total needs to be $4 million so that your credits are balanced with your debits. Okay,